Hello, welcome back. Time now for business news with our business editor, William Edwards. Hello, Will.
Hi, Louise.
Starting here in France, the government's getting ready to announce much-needed plans to kickstart the economy.
Yeah, France's competitiveness,
It's a
I
tough
should
one
say,
to say.
competitivity as well. It's been falling behind its neighbours, Germany and the rest of the Eurozone, for the last 10 years now, and it really does need a kick to get going. Now, on Monday, Louis Gallois, former head of some of France's biggest companies, he published a report on this, giving a few recommendations. Today we'll see whether the government takes them up. Now, what his headline was he suggested a cut of 30 billion euros to social charges that both companies and employees have to pay on top of their paychecks. But will the government listen? Well, according to Le Point magazine and others, they're planning, in fact, to put in place a tax credit for businesses rather than Louis Gallois' suggestions. This will be worth 20 billion euros, somewhat less than the competitiveness shock that Gallois has proposed, and it'll also be linked to the proportion of workers that companies have in France, obviously trying to keep those jobs in France rather than letting them go abroad.
OK, you say 20 billion euros has been set aside, but who's going to pay for the rest?
Well, we will see later on today, but apparently, according again to these reports, they say that there is going to be a rise in sales tax, VAT as it's known in the UK. This is going to go up to 20%, it's being reported, up just 0.4% there. But even though that's only a small rise, that is quite a big political jump for François Hollande, of course, who said he would not be raising sales tax. And as such, he's going to, in fact, see essential items, their VAT, drop by 0.5% to 5%, maybe just to mollify some of his supporters who may be rather annoyed that one of his major election promises, as opposed to Nicolas Sarkozy, his contender, he is not going to keep that if he goes ahead with this move.
OK. Well, we'll be hearing the government's full plans later, but in the meantime, many businesses have welcomed the suggestions that have been put forward in the Gallois report. Take a look.
500 million cartons of milk and juice roll off the production lines at this company every year. Despite an annual turnover of 303 million euros, staying competitive is a big concern. The company has been losing market share to German competitors. Its CEO has welcomed Louis Gallois' proposals.
The report recommends removing the family allowances levy, which for a worker that earns €1,700 a month amounts to €91, so that makes our companies more competitive.
Along with many employers, reducing the cost of labour is something he's wanted for some time.
A carton which comes from our factory costs around €1. About 20% of that is labour cost. So a reduction of 10% saves us 2 cents on each unit. That allows us to regain our competitiveness and to win back the business we've lost in France to competition from abroad.
He also intends to take advantage of proposed measures to boost innovation. The company already allocates 3% of its turnover to product development, and the CEO wants to increase that. But the workers here are worried. If employers' levies are reduced, they're afraid that'll translate into an increase in other taxes.
We never get a fiscal gift just like that. The reductions are good, but behind that we must see how that will affect us. A hike in VAT and social charges?
Both companies and workers are now waiting to see which measures the government will choose to implement.
OK, Will, if we could have an update on the markets, please.
Well, yes, absolutely. We'll have a look at the US first. That closed on Monday, the last day before the election, of course, all in the green, but a very actually quiet day of trading, one of the lowest volumes of trades so far this year. Let's take a look how things are going in Asia at the moment across the board there. It's also rather slow as well, actually. And it's only the Kospi in South Korea that's trading up. Small volumes of trades, of course, along with the US elections coming up. There's also the Communist Party Congress opening later this week, where China will choose its new leader. Of course, not such a surprise there. It's expected to be Xi Jinping, who's installed, but still, the markets will be keeping an eye nonetheless.
As will you. I'm confident of that. Now, to New York, and of course, everybody's still trying to get over Hurricane Sandy, but residents have an extra problem to deal with, Will.
As if they needed any more problems on top of the scarcity of basic goods. Apparently, some shops and tradesmen may be overcharging people for staple materials. That's according to New York's Attorney General. He says he's received hundreds of complaints from people who say that emergency supplies such as generators and even food and water are being overcharged. Now, in New York, under state law, there is, retailers aren't allowed to charge excessive prices for goods in a time of abnormal disruption to the market, it says in the laws. Now, exactly how you define excessive charges in a time of exceedingly high demand for materials, well, that remains to be seen, but there is now going to be an inquiry into this.
OK, well, staying with the US, Will, one of the best performers on the Nasdaq on Monday was Apple. A bit of bad news today, though, for it.
Yeah, Monday it announced that sales of the iPad mini were very good. They almost sold out. Over 3 million of them shifted on its launch weekend. But the overall picture for the tablet market is perhaps not quite so good for Apple. They've seen their market share slip from 60% to 50% in the third quarter. Now, that is still a very healthy share of the market, half of it, but that is quite a big drop in just one quarter. It does really show the coming on of the Android platform, which has really been improving in recent months, although it could also be that a lot of people might have been waiting for the iPad mini to come out, which was rumoured, of course.
OK. Well, next, Spain is one of the countries that's been worst hit by the Eurozone crisis, but the government is placing its bet on a new project that could help bring back jobs. It's a gambling development that's been dubbed Eurovegas, but not everybody's convinced. France 24's Sarah Morris has this report from Madrid.
Roulette tables, palm trees, a strip of luxury thematic hotels, the mythical Las Vegas could soon have a European copy in Madrid. Land on the outskirts of the Spanish capital is earmarked for the future Eurovegas. 18,000 slot machines, 3 golf courses and 36,000 hotel rooms.
In the first phase, we're expecting 60 to 70,000 jobs to be created. On top of that, we're expecting business tourism to be generated, really top-end tourism. We're talking about a series of 5-star hotels with 70-metre suites.
Skeptics say the complex isn't the solution for a country in recession. Building won't start in this area until December 2013. Unemployed workers here are already preparing their CVs.
It's our big hope. My girlfriend and I have already looked into where we can apply.
We'll probably have to work like slaves for a pittance of a salary, but that's how it is now. Anything resembling a job, and you leap at it.
Spain shouldn't get into the gambling business, say opponents of Eurovegas. They say Madrid shouldn't use this land for another big building project, which might not be profitable.
This project will worsen the crisis even further. It will turn southern Europe into a place where people come to spend money on gaming and vice. The money will leave the same way it came from. It won't be reinvested in the local economy.
Eurovegas is still not signed and sealed. The company Las Vegas Sands is still negotiating tax and legal terms with the government. Madrid hopes it can soon make the deal a symbol of returning investment to Spain.
And that wraps business news with our business editor Will Edwards for now. Stay tuned. Georgia Calvin-Smith coming up.